Good morning and welcome to another episode of Ben's Market Insights. Another tumultuous week this week. So let's kind of pass down into what we want to kind of talk about. Clearly, it's going to be about the Iran war. Clearly, it's about oil shocks and the political infrastructure around Trump and what Trump needs to think about. And we'll also have a couple of words around the NVIDIA analyst meetings of last week and the Microsoft downgrade from last night. So let's kick off with a lot of investors talking about the potential for a 1970s-like oil shock. So we kind of wanted to go and think about what that would look like and if it's really going to be the case this time around. Clearly, as a consequence of the inflationary or stagflationary pressure, we would likely need to see a much more prolonged incursion into Iran and the closing of the Straits of Hormuz than we currently have at the moment. So that duration is a key factor here, but also impact. So it's very interesting that when we think about the amount of oil that's required to generate $1 million of GDP growth in the US has fallen some 70% since the 70s oil shock of the Yom Kippur War and in the early 70s. That's pretty obvious. I think it's intuitive, at least, maybe not the number, but it's certainly intuitive that we are reliant on so many different forms of energy today than we did then. But at the same time, it's also interesting to see that the oil in the energy mix is down from a peak of 48% in the US economy in 1978 to what we now see is just less than 38%. Again, intuitive, you'd expect the oil mix to be lower. But at 38%, it's still pretty high. And that does have clearly an impact in terms of the potential for stagflation in the economy in the US. But at the same time, I feel it's probably a little bit of a media hype to try and push headline news flow that all is going to unravel in the US economy and we head into a recession, a stagflationary recession with costs moving higher. I do think that there is an argument to make for that if there is duration to this conflict. But I also think that the impact of the oil price is less on the US economy today and therefore G7 overall, probably more of an impact in Europe than the US. But nonetheless, if the duration is not there, I don't think that we are going to end up seeing this stagflationary impact coming through into the US economy. So why is the premise in my mind, though we don't see a continued duration to this conflict? I think it comes back to the midterms in November. We've consistently talked about this as the issue that Trump has foremost on his mind. I think it's becoming very clear now that with a 35% approval rating at this stage before the midterm elections historically has meant that the House almost certainly goes to the other side. We've felt that already from the kind of affordability issues that we've seen in pre-war, but this is only going to become a more focused issue now that we are at war with Iran, or rather the US is at war with Iran. If the House is gone, and I suspect that is, to me at least, is a given, then we look at the Senate. The Senate has not really come into the limelight just simply because the Republicans are defending 22 of 35 seats in November, and they currently have a 53 to 47 position in the Senate with the vice president vote as well. Now, what's now looking more likely as the approval ratings keep falling for the Trump administration is that there are genuinely becoming 4 seats that are marginal. One is Susan Collins' main seat, North Carolina, where Tom Tillis is retiring, and then Texas and Ohio are both open seats. So the Dems could win those, and if they do, we move towards a 51-49 in favor of the Democrats in the Senate, with, of course, the vice president holding the equalization vote. So to a large extent, we end up with a neutered Senate. So a genuine lame duck presidency post-November, with a House that's sitting in Democrat hands and a Senate that is essentially balanced out and can't really pass anything after that period. There is a further bad news potentially for Trump, in as much as if the war were to continue and sadly body bags start coming home as a ground offensive takes hold, then we start to see the likes of Alaska, Iowa, Florida, and Montana, Florida being Marco Rubio's seat that he gave up to join the administration, potentially becoming up for grabs as well. So that really changes the scene altogether. So what does Trump do now? Well, clearly, and we started seeing it as of Friday, and we saw it also last night, the administration and all their advisors are spending all of their time thinking about what the off-ramp, the exit out of this situation is. Clearly, as most pundits would have it, we are probably going to see Trump making a suggestion that his objectives, and they did that on Friday with a number of suggestions that they put, or objectives they put forward that have been met. And once those objectives have been met, and they pretty much appear to have been met, then that's the US's involvement done, and that they would move on. Whether those objectives have genuinely been met, or whether Iran agrees that those objectives have been met, is a side matter. It's when Trump decides that the war is over, he feels that that's when he can at least start to pull away. It's not as easy as that. We all know there are two proponents in this game, and Iran is certainly not at a point where it will effectively. There's no way that Iran is going to surrender in this scenario. The other is to create an environment where Iran understands that it can trade, or rather it can build its armory to within a specific range. Anything above that results in a seasonal incursion back to bring them below that armament range. That's expensive, and that expects some kind of cooperation from future administrations. Not sure that that's doable, but it's certainly something that has been going on in the Middle East for some time, and potentially likely to continue going forward, i.e. that whenever there's a perceived threat, the US and Israeli forces go in and reduce that threat to a manageable level. And that could be the future we now face going forward. The other elements are clearly that the regime change in Iran is now pretty much off the table. It doesn't look like they're going to be able to do anything on that front. So that becomes a back burner issue. And then I wonder also if the ask of $200 billion by the Ministry of Defense to bolster up the armaments in the US is such a big number, and it's literally more than the next three departments' budgets, that potentially that having a large number such as this is actually the point here. And that is that then Trump can blame Congress for not approving that $200 billion package as a reason why he needs to pull out from the war. So it's not really his fault, but he's being hampered by this by Congress and the Democrats. So that's another potential off-ramp argument. But we're already seeing from last night that he is appearing to be in negotiations with no one knows who, that suggesting that a ceasefire could well be on its way. Those are the reasons why he has to start to think about shortening the duration of this warfare. His midterm opportunities are slipping away. The Senate is the key factor in his mind, and I suspect that we start to see a withdrawal from this warfare, which clearly then impacts the price of oil and the price of assets. And I do think that there's potential for a short-term bounce when we see this secession likely to occur. Going to the micro world, so NVIDIA announced that they had some $1 trillion of pipeline going through to 2027 for the hyperscalers of their key chip sales, which is a pretty substantial number. It was pretty much expected, hence the muted performance of the stock. And I guess one of the things that we need to think about is what's the sort of spoiler here? What's going to make this go wrong? For me, ad spend is at the heart of the issue here. Ad spend is everything, because what happens is that the hyperscalers are effectively using the excess cash flow generated from their advertising businesses, i.e. Google, and not so much Microsoft, but certainly they have excess cash flow coming from their other business, and in terms of Amazon. And so what they are then doing is effectively putting that money towards their data centers. Those data center revenues will allow them to target customers and clients even better going forward. And that evolution essentially starts to allow the ultimate brands and clients to get a better return on their advertising investment. Now, so therefore, if advertising is plays such a key role in this capex spend going forward, then clearly economic slowdown from a war is going to slow down advertising spending. And that is the main issue, I think, that these hyperscalers and the clients and the brands and the advertising world is really need to be very worried about. I suspect, again, as before, that we do see a cessation of this war fairly quickly, and we start to see growth coming back into at least a sort of 2 to 3% level in the US. We saw Microsoft downgrade by Stagflation yesterday. I don't think that that's a huge factor that plays in the medium to long-term future of this company. At the end of the day, they still have some $625 billion order book, of which 25% turns into revenue over the next 12 months. They probably have better transparency than most other large Mag 7 stocks. So I continue to believe that the Mag 7 play here, particularly at the current valuations and particularly at the pullback that we've seen, is probably still a relatively safe area over the medium term. Have a great week. Speak to you soon.